A lot of traders love to use trend lines, and rightfully so. They are great and amazing trading tools that will help you find good trades and time the perfect entry. However, there are also a lot of problems that traders have. So in this video, I'm including 4 advanced trendline trading secrets, which are tips, tricks, and things that you can use for your strategies to find better trades. And I've included a lot of step-by-step trade and chart studies that will help you understand trend lines on a much better way. First is the concept of trendline clusters and how this can help you understand drawing and finding better trend lines. So trend lines, as the name suggests, can only and are mostly used during trending markets. So you need to have a market that is trending up or down. And what we then do is generally we look at the swing highs or the swing lows. In an uptrend, typically you want to connect the swing lows. In a downtrend, you want to connect the swing highs. Why is that so? First of all, in an uptrend, when you connect the swing lows, you can use a trend line to find pullback opportunities into the trend direction. And also, if a trend line in an uptrend here connecting the lows is broken, what does it mean? It means that the price is falling underneath historical lows. So the trend dynamic is changing. The price is not making higher highs and higher lows anymore, but the market may now be making lower lows and lower highs. So it's shifting from an uptrend to a downtrend. So when we look at those lows and we just start connecting them, what we see, we have a first trend line here. You can see 1, 2, 3, 4, 5 great touch points, but we can draw other trend lines. We can look at this trend line, for example, which gives us a slightly different angle. However, it is also a valid trend line because you can see we can connect the swing lows and we get this trend line. We have enough touch points. Just a rule of thumb, for a trend line, you need 3 touch points, whereas on a horizontal support and resistance level, you only need 2. For a trend line, you need 3. But the story doesn't end here. We can look at this trend line and we get another. And so what is the right trend line now? All of them seem to be valid, all of them seem to be active. And that is where the problem, or one of the problems using trend lines start, because a trend line is more subjective. There are infinite ways how you can draw a trend line because they are diagonal and you have 360 degrees practically at your fingertips that you can use. Wherever on a horizontal support and resistance line, there's only one way you can use them because they are flat and there are just one way to draw a horizontal level. So when it comes to using those, I would recommend, if you find something like that, go for the one that is furthest away. For example, if you're looking for an uptrend and you want to buy here an existing uptrend, look for the trend line that is furthest away. It would be a little bit aggressive to use the first trend line because obviously all of them 3 seem to be valid, all of them seem to be active. However, if you use the first one, it is more aggressive because the market may break through it and then just go to the next one. And if the price breaks through one of the first trend lines, like it did here, it doesn't mean necessarily that this trend line is bad. It just means that there is another trend line hiding somewhere that may also be valid, and the price is then growing to the lowest one, and you may not be even in a wrong trade. You may just be a little bit too early. So when you're looking for pullbacks, go for the one that is furthest away, which here now is this one. Prior to that, it was this one here. So up until this point, this is the lowest trend line. Then there came a lower trend line that was then moving here. Also, when you look for a breakout, this is a very helpful finding actually. If you see that there are multiple trend lines, there's also a support and resistance level. So if you want to trade a trend line breakout, you want to make sure that you get on the opposite side of all of those concepts, on all of those drawing tools that you have on your charts. And this is then even a more significant signal. So this is a good thing actually, because it means that if you find a cluster of moving averages, a trend lines, a support and resistance level, maybe there's also a pivot point somewhere, and the market can get on the other side, that's a very meaningful signal because it means that the market has enough momentum to break all of those criteria, all of those tools, and then you're looking at a much stronger and much more meaningful signal. So here, for example, the market made its way below all of that. You can see a huge break of momentum. And then the market is coming back into this. Very interestingly, and this is where we come back to the fractal nature of the markets, we can go from the 30-minute to now the 5-minute time frame. And here when we zoom in, you can see we find another trend line that is very interesting. 1, 2, 3, 4 touch points. Great trend line, very active one. And now we can see that the market is often shifting from trend line to trend line. So what we have is a trending market, another trend breakout, consolidation. And very often you will see that this is a common behavior. Trend consolidation, and so on and so forth. So in this case, you can see the market broke below the trend line, broke below the last low, which I marked here. Then you can see we dipped even further back into this. So whereas we had a retest here, now we have a break and retest here again. So this is the fractal nature of the markets. What you see on the higher time frame, you will see almost in an identical way on the lower time frame, just on a different time scale. But there is no better or right time frame. There is not a time frame where technicals play out better. Everything is connected, and whether you use the higher or the lower time frame, it doesn't matter. Price is fractal, which means that all patterns repeat themselves on all the time frames. And you can see afterwards, this is what happens. So you can see we are starting with a macro trend on the higher time frame that is then broken once we get below the trendline cluster, once we also make lower lows. And then once we get out of this short-term consolidation phase, then we roll over and the trend continues to the downside. Second concept, let's talk about a trendline pullback to breakout. What does this mean? And let's go into the charts. So first of all, we have here a trending market, and in this case, we are not looking for a trendline breakout, at least not initially. First, we are looking for a pullback. So what we have here is an uptrending market, very clear. The market is moving higher. And in an uptrend, we connect the down points of the trend line or of the trend, and then we look for a trend line. And when we see that the market is coming back to a trend line, this is now the third time. So this is not random anymore. When you have 3 touch points on a trend line, it becomes not random, and we have a valid and active trend line. At this point, we can zoom in, maybe go to a lower time frame, and look for trading opportunities with the trend away from the trend line. So this is a great pullback strategy approach. So we zoom in a little bit, and you can see here's also a previous swing low. You can see when we extend it back, there has been some agreement on the level. We can also see if we add our pivot point, which is here the weekly pivot point. You can see we are trading above the pivot point, which is a bullish signal. That is great. That's what we want to see. And when we zoom in now from the 15-minute time frame, whereas previously this was the 1 hour, we are now on the 15-minute. Now we can start developing trading plans. And what we generally are going to do is we look for structures. So first of all, we have a small structure here. We have a previous support area that's turning into resistance. We can look a little bit ahead and then see how the market keeps breaking those structures. It is moving from resistance to resistance, breaking and retesting those areas. And this is a very, very common theme in an uptrend. So the idea is that you start on the higher time frame, you look for an active trend line that the market is moving back into. Then you drop to a lower time frame, you look for double bottoms, you look for structures, and then you simply trade them from structure to structure, either with a breakout or a break and retest approach. And then the market is coming back to the trend line another time. So you can see 1, 2, we looked at this, and now 4th time. We also have a very big level here. So let's zoom in and see what is actually happening. We are breaking the trend line. That is a significant difference, whereas previously the market was able to resist the trend line and use it as support. Now the market is falling below the trend line. And look at how the market is falling below the trend line. We have a very strong bearish move here. And we have now a retest of the trend line, whereas previously the market used the trend line as support. The market may now be using it as resistance. So we are trading into it from underneath. And you can see the market is retesting the highs as well. So as the market is now using the trend line from underneath, and you can see it's not a perfect situation, but every time the market shoots above the trend line, it's being pushed down. Shooting above, being pushed down. Shooting above the trend line, being pushed down. So this is a very, very strong bearish signal now. So if you are, for some reason, in a long trend or trade, this is a very, very important signal that you have to consider taking an exit, because this is now looking very bearish. The market is rejecting the highs. The market is rejecting a trend line now as resistance, and there's not a lot of bullish pressure anymore in the markets. And you can see afterwards the market rolled over. We are breaking below support, retesting it as resistance, and it all started with the violation of the trend line. So the takeaway message from this point here is that if you see that a trend line is being broken, that is already a first heads up that something very significant is changing in the market structure. And if the market then cannot stay above a trend line, and every time the market tries to get back on the upper side, it is being rejected and is rejecting the highs and not able to push above highs, giving you engulfing candlesticks here at highs, that's a very, very important market tell. So you can see a trend line is good, but only if you look at the trend line in the bigger picture, in the whole context, then you can make a lot of sense out of this. And you can really see what is going on here between the bullish and the bearish side, who is stronger, who is pushing, who is gaining strength, who is losing strength. And then it becomes a very, very fascinating view on the markets. Whereas where you just look at a trend line and then you just look for a bounce or a breakout, that's usually not good enough, and that's where a lot of traders run into problems. So go a little bit deeper, look at the other concepts and try to combine it with a general trend line approach. Let's take a look at Trendline Exhaustion and how we can use this very interesting concept. So again, we are starting with a trend and we just connect the lows in an uptrending market. We wait for the market to come back into the trend line, and you can see now we have 1, 2, 3, and that's the 4th time that the market is back in the trend line. We can also add the pivot points, and we can see that the market has been trading above the pivot points for now. So this is a bullish signal. But when we follow the market a little bit later, you can see that we are running into problems for the bullish side of the market. So here is, when we zoom out, this is the highest point in this uptrend. However, usually in an uptrend, what you want to see is that highs are broken and the market obviously keeps making higher highs, retests the highs at support and follows this rhythm. What you don't want to see, if you are looking for a bullish trade, or maybe you're in a bullish trade already, you don't want to see that highs are holding. This is now not a bullish signal, but this is more of a bearish signal, where a previous high, the highest point of a trend, is not being broken. So the market cannot continue and cannot keep making higher highs. That is a very bearish signal. Also, what you don't want to see is that the market is falling below a trend line. For now, it seems like the market, when you look at this, the market broke below the trend line but was rejected. However, the real important signal came here later. And we call this a spring pattern. The market tried to break out and was rejected immediately. Within the next candle, the market was back below the highs. That is not a strong signal. Usually what you'll see is if you're in an uptrend, the market breaks a high, makes a push higher, and then makes a retest. What you don't want to see is a breakout and an immediate rejection. You can see we can add here the lower trend line to the picture. So we have a little bit of added confluence. And now you can see we are breaking not only below the first trend line, we are also breaking below the second trend line. We have made another attempt prior to that to break above the previous high that we made. So the fake breakout here was being tested again and rejected. So you can already see that for advanced and professional price analysis, looking at a trend line is not good enough. You need to look at the bigger picture, and you really need to look at the nuances of price action. You need to look at how is the market behaving around the high? How is the market testing or breaking out? Is it being rejected? Are we falling below a trend line? What is the momentum structure? Here you can see we are suddenly seeing huge red candles that we have almost not seen in the previous uptrend. You can see here is a very, very key level. So if the market falls below this major key level, this is now going to give us a big, big bearish signal. And this is what happens. First, we break below the level. We are testing the pivot point. At first, it seems like the market can recover and it can defend the pivot point, but not long. Just a few candles later, the market is below the pivot point, and this is a very, very bearish signal. If a market falls below a pivot point, especially with all this context, the failed breakout, the spring pattern, the second failed breakout, the break of the trend line, the break of this major level, and then finally break of the pivot point, those are all signals that really confirm the bearish side. And you can see when we zoom in, how does this look on the lower time frame? We are on the 1 hour. Now we are on the 5 minute. So again, we can use the fractal nature of price action. And the patterns that you see, the rhythm, the price action, what you see on the 1 hour is exactly the same on the 5 minute, the 1 minute, the daily, the weekly, or the monthly. So if we know how to read those concepts, we can apply to any time frame. And you can see now, what do we have? We have a trend line on the 5 minute as well. And what does this trend line tells us? It tells us that, first of all, the market bounced higher quite a bit off the trend line, but the next time there was almost no bullish interest. We moved into the trend line and then we're not even able to come close to the previous highs. So in and of itself, this is again a micro bearish signal. And then we break below the trend line and then we broke below the pivot. So you can see how we can start our analysis on the higher time frame, the 1 hour. We can see how weak the market is, and then we go to the lower time frame and we can see more weakness. And you can see when we zoom in, this is how it looks, the break of the trend line. And if you want to look for a trading strategy, you would typically time it on the 5 minute. So you could use, for example, the trend line breakout. An idea would be to use your stop loss above the previous swing high, which is here, and then ride it as the trend unfolds. So here, was the first breakout, and you can see the fractal nature of the market is repeating itself. We have an initial push, then we have another consolidation, which looks almost identical. We have a trend line, a flag pattern, we have a high area. You can see we have a resistance in this area, which the market is not able to break above, which is again a bearish signal. In a bullish market, you would see that the market is able to make higher highs. We are staying below the pivot point, and we are not able to break above a resistance level. Now we have the break and the retest of the trend line. So the trend line is going from being support to now being resistance. And then the downtrend keeps unfolding. So really, really interesting study. And the takeaway of this is really that it is about the nuances. It's about connecting different concepts. It's about starting with one concept, getting an idea of what you're looking at, and then looking at all of those microstructures and those subtle clues, price action, rejections, behaving around a breakout level, how is the market trading around the previous high and low, how are rejecting levels, and then this is how you can go from this very simplistic way of analyzing the market, which many traders struggle with because it's just too simplistic, to being able to analyze the charts like a true professional.